Hello, private equity lovers, and welcome to this Q&A session broadcasted by the Luxembourg Private Equity Association. Today, members of the Young Leader Working Group will be answering a couple of questions about hot topics in the Luxembourg private equity market and key terms of private equity funds. Let's kick off directly with a question to Mathieu de Donder. Mathieu, we have heard a lot about continuation fund lately. It seems like a very en vogue product, but can you tell us what a continuation fund is exactly and how they work?
Thanks, Mathieu. In a nutshell, a continuation vehicle is a new vehicle set up by a sponsor with the purpose of acquiring assets from an existing fund managed by the same sponsor. Concretely, what does it mean? It means that the continuation fund will enter into a purchase agreement with the existing fund into a purchase price for the acquisition of such assets. The continuation funds will be set up with investor from the existing fund and new investor. Let's first talk about the LPs of the existing fund. They will have a choice between choosing for liquidity and cash out the part of the proceeds coming from the sale of the assets to the continuation funds, or they can opt for rollover. And by rollover, it means that they will reinvest the proceeds of the sale into the continuation funds and be an investor in that new entity and remain exposed to the original assets. The continuation funds may also raise funds with new investors who may benefit from more mature assets with a shorter life cycle and thus quicker return. The most obvious reason for that fundraising with new investor is to fund part of the purchase price to be paid to the existing fund. But not only, one can imagine, for instance, that the continuation fund would like to pursue add-on acquisition and an acquisitive strategy that will run beyond the term of the existing fund. So one could ask, but what are reasons driving a continuation fund? I think that there are a number of reasons why a continuation fund could be of interest. Typically, the most common scenario is when an existing fund reaches the end of its lifespan and the GP believes that certain remaining assets of the fund can gain further value in the future. And for instance, a GP may consider that extending the runway and keeping exposure to certain quality assets is a preferable approach than selling them to a third party and even to find other performing assets, in particular in a red-hot market where quality assets are rare and difficult to acquire. Another example is where the sponsor believes that implementing certain add-on acquisition after the terms of the existing fund is conducive to unlocking the future value of these assets and will therefore use the continuation fund for this purpose. From a legal perspective, what would be the main risk to consider in a continuation transaction? A well-executed continuation transaction can be quite complex, and particular attention should be paid to any restriction or obligation under the existing fund documentation, the structuring of the transaction, and any tax impacts on the LP on the transaction, as well as any regulatory requirements that may be triggered by the transaction. But what is really at the core of a continuation transaction is a question of conflict of interest, as a sponsor is involved on both sides of the deal, for the existing fund as a seller and for the continuation fund as a buyer. Managing conflict is key, and the sponsor will need to convince the LP of both funds that the transaction is in their interest and that its terms are fair. Sponsor will be well advised to engage with the LPs early on with a compelling business narrative about the detail of the transaction, and also involve the advisory committee, and if appropriate or required, seek its approval to the transaction. The valuation of the assets will also be front and center in the discussion, and the sponsor will need to demonstrate that the purchase price to be paid is the outcome of robust, diligent price discovery process. For example, by deciding to back the purchase price by fairness opinion from an independent expert, or by conducting a competitive sale process and comparing the proposed price in the continuation transaction with bids received in the auction process.
Thank you, Mathieu. Sounds like a very interesting and useful product. My next question would be to you, Gilles. I've heard this quite complex term. I will try to say it correctly. Retailisation. Could you maybe define that concept for us?
Well, to start, even though it is hard to consider high net worth individuals the victims of inequality of opportunity in the asset management industry, the regulatory framework that applies to European funds generally only distinguishes between professional investors and retail clients. So professional investors broadly includes regulated and larger entities such as insurers, banks, asset managers, pension funds, larger corporations and trusts. And even though individual investors can opt up to this professional status, the required criteria are challenging to satisfy, even for people working in the financial industry. So this classification is important for private fund managers who can rely on a passporting system to market their private equity funds to professional investors across the European Economic Area. However, there is no harmonized regime for marketing to retail investors, which results in significant divergence across the member states. So countries such as Denmark, Germany, and Italy, for instance, they have created a semi-professional category, which is subject to high investment minimums, and managers and their distributors as well may need to comply with local suitability, transparency, and product governance rules. However, the retail market, it holds significant potential for fund managers to expand their investor universe, and conversely, accessing private equity may offer attractive opportunities to retail investors as well. And Luxembourg, as a global leader in cross-border fund distribution, is well positioned to take advantage of this retailization trend by offering a home base for the core of these complex fund structures, which often include bolt-ons such as feeder vehicles, insurance wrappers, and fund-linked notes to ensure the widest possible distribution to retail investors in each target jurisdiction. It is also increasingly common for fund sponsors to partner with wealth management platforms, which then act as gateways to non-institutional capital the fund could not otherwise have accessed from a regulatory perspective. And even though this streamlines a substantial amount of investment suitability checks, it may in turn result in interposed fees and less of a direct investor relationship. And indeed, it's a big trend. It remains to be seen whether the proposed changes to the pan-European LTIF regime, which offer, amongst others, increased flexibility on the eligible assets and strategies, will significantly benefit the development of this retailization space. Finally, with the current succession of private equity firms listing on stock exchanges, maybe some investors may still turn to the public markets to gain at least indirect exposure to this private asset class.
Thank you, Gilles. That's very clear. Turning to Vittoria now to speak a bit about waterfall distribution. Vittoria, I know that this is a very sensitive topic for GP and LPs when negotiating the terms of a private equity fund, but how do they manage at the end of the day to align their interests?
So I think the first point to address is what exactly is a distribution waterfall? So in a nutshell, and to keep it short and simple, it's a common term used in the private equity world to refer to the way how profits from an investment make their way down to everyone involved in the venture. So the parties that are typically involved are the limited partners, so the investors that contribute the majority of the equity on a deal, and the general partner, also known as the sponsor, who are basically the asset managers. Now, GPs, so the general partners, they usually contribute a minor portion of the equity. However, they do the majority of the work involved in operating the fund. Now, the goal of a private equity investment structure is to align the interests of the parties involved. And the distribution waterfall does exactly that. A structure it's exactly that, a structure that is designed to ensure that the interests align in a way that properly compensates everyone involved in the investment. So how does it do that? By spelling out the order in which the profits are allocated between the investors and the managers. Therefore, basically setting the priority of the parties and ultimately creating the right incentives. So a distribution structure can be visualized as a set, if you want, a set of buckets placed one below the other, a cascading structure, hence also the reference to waterfall. Each bucket defines an allocation of profits. When the first bucket is filled up, the profits flow into the second bucket, and so on. In this way, the capital flows from the limited partners, which are favored by the initial buckets on top, to the general partner, which is favored by the buckets that are further down from the source. Such structure of allocation essentially protects the interest of the investors, and at the same time, it incentivizes the general partner to maximize the return of the fund. Now, what is important to note is that while it is an alignment because limited partners are paid first, the distribution waterfall itself is an asymmetric allocation of profits because the sponsor, so the general partner, contributes the minor portion and receives the larger portion of profits. Now, while I think this answers the questions, I think that just to complete the picture, I will shortly touch upon the mechanism of the distribution waterfall, so how it's structured. Obviously, distribution waterfalls are typically customized, but we can see 4 tiers typically, or think of them as levels, or as we said before, buckets. In essence, we have the first bucket, which is the return of capital. So the first step through which you ensure that 100% of the distributions go to the investors until they recover all of their initial capital contributions. Then you go to the second bucket, which is the preferred return, whereby 100% of the further distributions go to the investors until they receive the preferred return on their investment. Usually we see a preferred rate ranging between 7 to 9%, 8 to 10%. Then we go to the third step level bucket, however you want to call it. And then you have 100% of the distributions that go to the sponsor of the fund until it receives a corresponding share of the profits of the distributions paid to the investors in the 2 buckets before. Lastly, we come to the carried interest. This is a stated percentage of distributions that the sponsor receives. It represents the portion of any profits provided to the GP regardless of the initial investment. We usually see an 80-20 split, and this tier represents the main source of funding for a sponsor. In return, it's the GP's job to ensure that the LPs receive their initial investment back together with the preferred returns. Obviously, in practice, things get a bit more complex and could be discussed at length, but for the purposes of this session, I think we can stop here as the intention was really just to give you a glimpse of the typical components of a distribution waterfall.
Thank you, Victoria, and obviously very technical item that you managed to explain very clearly. Talking about joint venture now and turning to Fuzia. Fuzia, could you maybe explain to us the key aspect we have to keep in mind when setting up a joint venture?
Many thanks for your question. In the past few years, we have seen major leading companies and PE firms entering into at least one new GV, and in some cases, several. The deal volume has remained high in recent years, which is not surprising given that GVs allow to have access to new markets and distribution networks, limit upfront investment, share the risks and costs, and have access to greater resources, including staff and technology. This being said, one needs to understand that GVs are not sprints. In the rush to complete a deal quickly, inexperienced GV planners do not pay attention to the foundation steps. This is the reason why 3 aspects must be carefully analyzed at an early stage. The first one relates to the setup of the GV, because various questions should be answered. What is the business strategy of the GV partners? The review of the business plan will help them to define the expectations. Who will be the partner? The perfect partner will be the one that has complementary skills and assets, so that the GV company will offer a broader set of skills and knowledge. What are the expected synergies? Are they identified? Are they reasonable? In addition, Is there any reputation of risk when you combine your skills and process with a new player? After such initial analysis, the second step can start, the negotiation phase of the JV agreement, during which various aspects must be agreed. The first one relates to the day-to-day management. What is the intent of the partners? Do they want to be involved in the decision-making process by way of a board seat? The minority JV partner may want to go beyond and get a veto right for certain decisions, such as approval of the business plan or the annual budget, adoption of major investment or divestment decisions, appointment of senior management. Likewise, reserve matters will have to be clearly defined. Do they need to be approved? At which level? At the board level, at the shareholder level, or both? Thresholds should be introduced to avoid long discussions and delays in the decision-making process. In the same vein, the parties should have a common understanding of the distribution policy, including the reinvestment policy, because it will have an impact on the return expected. One last aspect should not be ignored in 50-50 JVs, the possibility of a deadlock situation blocking the normal functioning of the JV company. Firstly, the parties should envisage a mechanism enabling the JV to continue its activities. Here, the right communication paths should be agreed, including the escalation process. The matter can also be referred to an independent mediator or an arbitrator. The second aspect is a pure divorce. Even if a divorce is never easy, it has to be anticipated and prepared during the engagement phase. There is no, under Luxembourg law, a legal put option or a legal call option. Therefore, the parties may freely agree the divorce steps in the JV agreement. In this respect, the valuation and the price determination will have to be carefully contemplated as well. Once you have set up the JV and agree on its management, you can expect a successful exit. The two main concerns the JV partners have are, one, the control over the form and timing of the realization, and two, the ability to maximize the return. The well-known drag-along, tag-along, and right of first refusal are, among others, viewed as providing control, facilitating a clean exit, and granting the ability to maximize return. However, they have to be adjusted on a case-by-case basis. I will not describe each of these mechanisms. I'm going to limit my remarks to a few questions. When negotiating a drag-along right, the willingness of the minority partner for non-cash consideration will have to be assessed, notably if there is no open market for the exchange shares. In addition, variation in sale terms, including the well-known representations and warranties, cannot be ignored. Part of the negotiation of the tag-along will focus on the determination of the threshold trigger. A common point of negotiation is whether the tag-along right should apply to any sale of shares by a majority partner or only to a sale of all of its shares. And with respect to the latest mechanism I mentioned, please allow me to draw your attention to the first question raised by many JV partners, how to fund a right of first refusal. After answering this first question, some of them will not insist for such right. I cannot conclude without affirming that a JV can lead to major success. When bringing two cultures together, conflicts may occur. Rather than letting the culture of one company dominate the other, the two parties should be ready to embrace their differences. And it comes with anticipation and planification. Thank you for your attention.
Thank you, Fuzia, for this very thorough explanation. Let's talk a bit about limited partners protection. Kurt, when looking at private equity fund documents, we often see references to the LPAC. Could you maybe tell us what LPAC stands for and explain how they work in private equity funds?
Thanks, Mathieu. LPAC stands for Limited Partners Advisory Committee. The vast majority of private equity investment funds have such advisory committees, which are composed of representatives of limited partners. The role of the LPAC varies from fund to fund, but traditionally relates to three main categories: conflicts of interest, specific consent approval or waiver, and general oversight. The traditional primary role of an LPAC is to act as a decision-making body with respect to conflict that may arise between the interests of the limited partners and the interests of the general partners in the course of the life of the fund. In order to resolve these conflicts, the LPAC is typically given the right to prior approve or disapprove conflict of interest transactions, Examples of these transactions are investments in portfolio companies of affiliated funds, purchase of securities from or sales to affiliates of the general partner, or service contract with affiliates of the general partner. Another traditional role of the LPAC is to grant specific consent, approval, and waivers. The partnership agreement may contain certain provisions which require the consent and approval of the LPAC, such as, among others, the approval to the extension of the investment period and the reapproval or replacement of the key persons. LPAC may also be entrusted with the power to waive certain restrictions or thresholds set forth in the partnership agreement, such as caps on investment in a single portfolio company or removal of the restriction on the type of assets which may be acquired. LPAC are sometimes also vested with a general oversight role with respect to the activities of the fund and the general partner by receiving additional financial report or by having access to the fund auditors. In most cases, the general partner will appoint limited partners to the LPAC. The criteria used by the GP to determine which partners to appoint to such committee is largely based on the amount of capital committed. As a condition to investing, certain limited partners, such as institutional investors and anchor investors making substantial capital commitments, may require an appointment to the LPAC, which is typically formalized in a side letter. The typical LPAC comprises between 3 and 12 voting members. A representative of the GP usually serves on the LPAC as a non-voting member. The Limited Partners Advisory Committee should be distinguished from the occasional Fund Managers Industry Advisory Board, composed of persons that are experts in the fund's investment focus and who provide advice and making insights to the general partner.
Thank you very much, Kurt. Obviously, a crucial point for LPs. And last but not least, ESG, of course. Harrison, ESG is all over the place, but can you maybe explain to us how important ESG considerations are for private equity firms today?
Hi, Mathieu. Many thanks for your question. ESG is indeed a hot topic for some time now. And indeed, corporate adherence to ESG standards has become a priority for consumers, employees, investors, regulators, board of directors, and company management. In other words, not only for the financial industry, but the society at large. Private equity firms and investment funds are also increasingly integrating ESG parameters into their investment strategy and acquisition processes. In some cases, they may even be obliged to do so. We may think, for instance, of the new private equity firms and investment funds are also increasingly integrating ESG parameters into their investment strategy and acquisition processes. In some cases, they may even be obliged to do so. Without going into the details of it, we may think, for instance, of the new European SFDR and taxonomy regulations. In the same vein, the limited partners of private equity investment funds, which include notably pension funds, university endowments, and supranational entities such as the EIF, often integrate ESG parameters into their own investment decision-making processes and want their money to be invested in underlying companies that, at least in part, favor good ESG practices, including, of course, enhanced ESG reporting obligations. As a result, private equity firms are now assessing ESG as part of their due diligence processes and their value creation and risk analysis. Private equity firms can even differentiate themselves by translating ESG metrics, as well, of course, as other factors they may consider, into a positive return on their investment. In this regard, and I will finish with this, although not directly relevant to private equity companies and funds, the ESMA, so the EU regulator for the financial sector, recently published in one of its latest statistical reports that for the year 2020, UCITS funds using ESG strategies outperformed quite extensively the non-ESG peers. I therefore really expect this trend to continue. Thank you, Mathieu.
Thank you, Harrison, and thank you all. That was super interesting. I hope you guys enjoyed this Q&A session as much as I did. Stay tuned, more to come. Bye-bye.